Equity Mates.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Welcome to another episode of Equity Mates, a podcast that follows our journey of investing. Whether you're an absolute beginner or approaching Warren Buffett status, our aim is to help break down your barriers from beginning to dividend. My name is Bryce, and as always, I'm joined by my equity buddy Ren, who's freezing over there.
Freezing!
How are you going?
I'm good, Bryce. As you've said, I'm freezing. The reason I am freezing is because we're in a new studio, in a new office. It's pretty exciting.
It is exciting. We've upgraded Equity Mates HQ. We're out of our WeWork office. We'd outgrown it. We needed a new space for creativity, to keep content flowing, to keep everyone updated on what's happening in the amazing world of markets.
They say that creativity is best when you're freezing cold, right?
Well, I hope this is a creative episode then.
So if people are watching on YouTube, they probably see me sitting in front of a nondescript wall. They probably see Bryce sitting in front of a plant that hasn't made it out of the plastic pot that we got from Bunnings.
Anyway, look, interior design isn't our forte.
This is MVP. We've moved in last Friday. And if people want to watch the move, we saved it as a highlight on our Instagram stories. We've also been doing some market updates from the rooftop. So it's all happening, but there's a lot of work to go here.
There is, but it's super exciting. The rooftop will be available at some point. We'll get some community members up, have a bit of a party. It'll be a lot of fun. Stay tuned. Make sure you're switched in and switched on to all of our social channels to keep abreast of that.
But Bryce, enough about us.
Yes.
Let's get into what's going on. And before we do, it's important to remind everyone,
we are not experts. We're not financial professionals. We are not licensed. We're here learning just like you, and nothing on this podcast should be taken as advice. Do not take financial advice from a podcast run by Ren and I.
Yes.
Anyway, Ren, today, massive show.
Not run by anyone.
Ren, massive show today. We've got more earnings wrap. America is taxing buybacks. Will companies care? We're going to talk about single stock ETFs. Can you believe it? We've hit that point in the ETF market. And are meme stocks back, or did they ever disappear? But Ren, let's kick off. You're worried about our future.
I mean, I'm worried about the amount of things that we say and how that seems to be coming back to bite people. But this is particularly about Larry Fink from BlackRock.
Yes.
In 2017. So this is about crypto.
So Larry's the CEO and founder of BlackRock, for those interested. Yes.
BlackRock is the world's second largest asset manager. They have the iShares ETFs and a bunch of other things. Just a few other things. They got $9 trillion under management?
Yeah, something stupid.
Do you know who the biggest asset manager in the world is?
Vanguard.
Too easy. Do you know who the third biggest is?
No.
I think it's State Street.
Makes sense.
Okay,
keep moving.
So 2017, Larry Fink, quote, "Bitcoin is an index of money laundering."
Okay.
Pretty strong. Mm-hmm. 2021 comes out and explains why BlackRock is bullish on blockchain but not Bitcoin. That was the real refrain for a while there. Mm-hmm. And then last week, they come out and announce, they pick Coinbase to provide BlackRock clients with direct Bitcoin access. What a turnaround in 5 years.
What a turnaround. And so you're worried about what we will be saying, looking back on in 5 years' time we've said.
You're coming out and say you've picked a fight with the RBA. How's that going to look in 5 years?
Probably
you
really
see
good.
Inflation is softening in the US?
Probably really good, but it is a big 180 from BlackRock, considering what's going on in the crypto market at the moment as well. But
what's going on?
Not a lot.
It feels like it's plateaued, and Bitcoin's holding around 20,000.
Yeah. Well, Larry's a bit all over the shop at the moment,
anyway,
I feel.
Yeah, I don't think we need to unpack it a lot. I think it's just interesting that people were so strong against it, and
now they're all flipping.
Yeah, maybe you know what? We're going to talk about single stock ETFs later in this episode. Maybe that's the thing that will slam, and then in 5 years
we're all investing in them.
Equity Mates will only be doing single stock ETFs.
Not bad. All right, Ren, let's turn to earnings wrap, because we're well and truly in the thick of it at the moment. Earnings coming from the States and also now starting to come out of Australia here. So let's start with the high level, the NASDAQ, the tech-heavy NASDAQ composite is up more than 20% from its recent June lows. Technically now it is in a bull market. What the?
Is that right?
Yeah. As of last night,
done.
time of recording.
We're through.
Just like a bear market is 20% from its highs, a bull market technically is a 20% rip up from a low. So considering where we were probably, well, what we were saying 5 weeks ago.
Yeah. But it feels, I don't know, maybe I'm just way too contrarian, but now like
This guy only 3 weeks ago was we're out of it, all clear.
Yeah. Well, I called the bottom a little too early, but I was
Lesson number one, never call the bottom.
But I was in the office being like, the worst has passed, blah, 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 as everyone was like, the sky is falling. But now it kind of feels like everyone's feeling too good. It's like inflation is 8.7% rather than 9.4%, and everyone's having a party.
This guy's never happy. Unbelievable. Anyway, if you're
Look, I think the takeaway is you just don't know.
you just don't know, and you've just got to stick to your strategy.
Imagine if people had sold when the panic set in like late May, early June, and everyone was like, this is going to be terrible, this is going to take a long time, because they were the headlines. That was the media, and like professional investors were coming out. Bill Ackman probably had a tweet thread saying the same thing, and then out of nowhere it's really rallied.
I think this is a classic example of why you need a strategy on how to deploy cash when the markets are going down, and not deploy 100% of your cash.
Or you just have a strategy that's market agnostic.
Yeah, dollar cost average, whatever it may be.
Yeah.
But I think what, everyone, oh, wow, the NASDAQ is in a bull market. Hey, guys, look at the local Aussie tech market. Index for the Aussie tech is up 30%.
Wow.
Since the
Cop
low.
that, America.
Cop that, NASDAQ. Up 30% since June lows as well. So
Okay.
it's also ripping. If you're unfamiliar with the Aussie Tech Index, it's got companies such as Xero, Computershare, Seek, WiseTech, which we spoke about last week, REA, which we'll speak about in a minute. Some of Australia's biggest tech companies pulling that market through. So we're back. Stocks are back. Everyone pile back in.
I think we've said this a number of times, and we'll keep saying it, that every bear market, like every market fall except for March 2020, has had a false breakout, a dead cat bounce, a whatever you want to call it. And so this could be that. And we could have another leg down, but we also might not. So with that helpful insight, let's keep rolling.
Insight there. All right, let's keep ripping through earnings. REA, realestate.com here in Australia, they just keep on plugging away.
Revenue up, profit up, earnings per share up, dividend up. REA
keeps going. We had actually interviewed their CEO, Owen Wilson, for our summer series.
Not that Owen Wilson.
It was a fascinating interview, gave great insight into their plans for international expansion as well. So check that out.
Yeah.
Ren, Zillow.
Yeah, well, I figured if we're going to talk about REA Group, realestate.com.au, we should talk about their biggest peer over in the States.
Yeah.
Who some may say played America's red-hot housing market over the last few years as terribly as you could play it.
Yep.
And their stock price reflects that. You know, they were trying to flip houses. They were trying to do all this stuff. But a stat that caught my eye from their recent report. So their numbers disappointed the market, we should say. This didn't disappoint me, though. So for context, Twitter, 330 million monthly active users. LinkedIn, 310 million monthly active users. They're social media platforms. Zillow, a real estate listing site, 234 million monthly active users.
Wow.
Just below Twitter and LinkedIn. Are you not amazed by that?
Yeah, it's pretty big numbers. I'm just trying to compare it to REA because they have something extraordinary as well. I don't think it'd be that many. But
well, I mean, Australia's population.
Yeah, but Australians love housing.
No, but these are unique users. This isn't.
Okay,
Yeah.
Gotcha.
So 234 million. I mean, I imagine that Zillow isn't just just American, but still.
Yeah, pretty impressive. Pretty big numbers.
Huge numbers.
Yeah, and they still disappoint.
Well, yeah.
So there's that. Let's keep moving, friend. Australian banks. NAB has disappointed.
Yeah, so I think this has been really the first week of earnings season. I guess it's been a trickle in Australia this week. So first week of earnings season in Australia. There's been a trickle this week, and the spigot opens next week, and we'll get a flood. But we got two of the big banks, NAB and CommBank. One disappointed, one didn't. Have a guess who was who?
NAB disappoint, CommBank doesn't.
Yeah. Nah, they both actually disappointed a little bit, but just CommBank disappointed less. They both grew though. NAB grew about 3%, revenue up about 3%, profit up about 3%. Not bad.
Yeah.
Below inflation, but CommBank was up about 10%.
Nice.
Like their numbers. I think the pleasing thing about CommBank, and this is all from memory, we should have written this down, but all of their key business lines were up. So home lending was up about 7%. Home deposits was like deposits from people like us was up about 10%. Business lending was up about 14%, and then business deposits was up about 15%. So some strong numbers there.
I saw the mix of their customers has really changed. They used to be the bank of the mum and dad, and now I think the majority of their home loans with customers who have average income of between $200,000 and $500,000 a year. So servicing
$200,000 and $500,000 a year.
Yeah, so going from the family bank to...
So they're eating Macquarie's lunch.
Yeah. Interesting change in customer mix. But let's keep moving. Ren, A2 Milk, a stock that has been a darling for some of the community of equity mates over the past sort of decade or so, 5 years or so. It's been rejected by the US.
Yeah, so if people haven't been following this story, Bellamy's, which is no longer listed, and Bubs, the goat milk infant formula player, have benefited from America's infant formula shortage after Abbott Labs had that contamination scare earlier this year at their Michigan factory. America, for some reason, is super protective of their infant formula industry. There's 3 US companies that just dominate: Nestle, Abbott, and one other. Anyway, the market, they realized how little resilience there was in their supply chains after Abbott shut down. And so they gave all these emergency authorizations for foreign infant formula makers to enter the US market. Bubs got in super early, and they've been killing it ever since. A2 Milk have been waiting. They've been trying to get this emergency authorization. Last week, they got turned down.
No good.
So not good. Yeah.
And the share price?
I haven't looked.
Probably got bombed. But speaking of bombing, ISelect.
Yeah.
Here in Australia, ISelect, an insurance company, comparison site, they've left the ASX after dropping 91% in value since they IPO'd.
Yeah. Well, I mean, they're getting acquired.
Since within 6 months of their listing, though, Ren, in 2013, within 6 months, they missed all of their prospectus forecasts and were being investigated by ASIC.
And their CEO quit.
And they lost their CEO. Not a great IPO.
No. Well, I mean, great for the shareholders that got out at the IPO.
Yes, but not great for the retail investors who got in.
Terrible.
Yeah.
So down 91%. The acquisition comes from a competitor, Compare the Market, well, the parent company of Compare the Market, at a premium. I think the stock was up about 70% on the day of the announcement. Yeah, I think it was trading at about 16 cents, and the takeover's at 30 cents. So good for people that bought in right at the bottom.
Compare the Market, those two little meerkats.
Meerkats, yes, yes.
Ren, BHP trying to buy Oz Minerals.
Yeah.
They say it's been a merger in waiting. Even the best companies fail is what we've got written here.
Yeah. So there's, BHP say this is about getting more exposure to future metals. Copper and nickel, I think, are the two main ones. But BHP for years have had trouble with their Olympic Dam project in South Australia, and Oz Minerals have mines like either side of Olympic Dam, and so many people are saying this is
squeezed.
This is about like efficiencies and synergies. You expand Olympic Dam and its two neighbouring mines into one big one, and you can use the same infrastructure and all of that stuff. But for me, it's just a nice reminder that even the biggest and best companies they still struggle.
They do.
And they still fail.
They do. So that's a wrap of what's been happening across the US and here in Australia with earnings wrap. But stay tuned on our social media. We've got a calendar of what's coming up this week. Ren, what have we got our eyes on for reporting this week? Some big names.
Yeah, so this week, as we said, is it a spigot? Is that the right terminology?
I don't know, but anyway.
The floodgates open?
Yeah.
That works.
Yes.
So today, on the day this episode released, a few that we're watching, JB Hi-Fi, Bendigo and Adelaide Bank, GPT Group. Then later this week, BHP on Tuesday, Tassel, the salmon farming company, Temple & Webster, the online homewares retailer.
Yep,
furniture
homewares.
retailer.
Yep.
Wednesday, Super Retail Group, Rebel Sport, all of that. CSL and Magellan. That'll be an interesting one to see. Thursday, we've got Transurban, we've got Blackmores, we've got Origin, the ASX themselves, new CEO. How's that new chess settlement system going? And then Friday, Cochlear, AGL, Cleanaway. So a big week this week.
Big week. I'm going to be keeping an eye on the sentiment from a number of companies and comparing it to that of the similar sort of sectors over in the States. Will the retailers, will the Walmart sentiment carry across to here in Australia?
Coles and Woolies.
Coles and Woolies.
They're not next week. They're the week after, I think.
So just going to be keeping an eye on what some of these CEOs are forecasting the next 6, 12 months to be like. That's worth keeping an eye on. But Ren...
we've set ourselves the challenge of trying to put a whole bunch of this stuff on our stories on Instagram. So hopefully you see it there. Otherwise, we failed in our challenge. But head over to our Instagram to keep up to date with this reporting season.
That's it.
The most important reporting season until the next one.
That's it. Oh, you can't hear. For those that can't see the YouTube video, we have a new Rodecaster system here for the new office, and I just gave Ren an applause, which you would have heard, but Ren's not wearing headphones, so you can't hear it.
Cool, keep it in.
Anyway, so Ren, let's move on. We both have a gripe to bring up. And that's what we're here to do, make the world of investing more accessible. And I'm sure...
yeah, by complaining.
No, I know that my gripe has
accessible.
actually been brought up in the community, so I'm happy that I align with that. But you kick off.
Okay,
I came in this morning and you were hot under the collar.
I was a bit hot under the collar, even in a freezing cold studio. So I'm not going to name the broker, but I tried to buy a stock that is dual listed in Europe and the US. And when I tried to buy the European version of it, I was told this is not suitable for European retail clients. Now, to be clear, this is not a CFD or an exotic product, an option or anything. This is just straight up the stock.
And you're an Australian
And
client.
I'm an Australian. I'm not a European retail client. And it is a massive company, like multi-billion-dollar market cap, all of that. And so I was troubleshooting it. I was like, what's going on here? Why can't I buy this stock? I had enough money in there. I've bought European stocks through this broker before, so it's not like I haven't got the authorization or, there's forms that need to be filled out. And then I try and buy the US version of it. They're only accepting closing positions on this stock, not opening positions. And so I've just got to say, why? Just let me buy the stocks that I want to buy.
Wait till Reddit hears about this.
You're not there to block. Like, you're an agent for the investor. You're not the market maker. You're not the exchange itself. Just take our orders.
Yeah.
And I'm sure there is a reason, but it just really annoyed me. I was a bit hot this morning.
You were.
Cooled down a little bit.
Hopefully you can get in at some point.
Well,
After they hear this.
Hopefully when I become a European sophisticated investor.
True. Ren, my gripe, a quick one. It does relate back to registries. I've been trying to transfer my employee stocks that I was awarded while I was at Woolworths out of that plan and just into my brokerage account because it's been sitting in the registry and not actually visible in any of my brokerage accounts.
Okay.
But the registries have this stupidly old, archaic process of confirming your identity and all of this sort of stuff. They only deal in letters. So when I transferred to a new SRN, they don't put the SRN online in your two-factor authentication portal. They send it via an a letter to your home. Now, my registered address is my parents' place in Wagga.
Okay.
To change the registered address, you need to
log
get a
in.
letter sent.
Okay.
So my parents are on this massive forwarding thing at the moment because everything goes to Wagga to then come to me.
Why are they forwarding it? Why don't they just take a photo of it?
Because that's just what they do.
Okay, well, it feels like that could shortcut it a little bit.
But anyway, it's just such a ridiculous process, ripe for disruption.
Yes.
I know that there is
Yes.
a registry out there that is disrupting this. I actually can't remember their name, but they're getting a lot of traction here in Australia. I'll try and find the name. They're going digital. If they can do it,
Oh my God!
so
Thank
so
God.
so can the rest. So I know that there are people in the community also having this struggle who live out rural areas. They don't live where their registered address is and have massive trouble changing all of their details and actually using the registries as they're supposed to be used. So if you're listening, registry, sort it out.
Yeah, I mean, it's not even about, like your parents being in Wagga or people having rural addresses or something. It's like every other industry doesn't need this much paperwork.
Yeah, it's called digitization.
And I'm sure there are like archaic rules from ASIC or the ASX that mean that some things have to be recorded in paper form. But it's like you guys have the ears of some of the biggest companies in Australia and the ears of the ASX. Like,
Get it going.
work cooperatively to change it. No one appreciates the amount of paperwork we get.
No one.
No one.
No one. Anyway, so Ren, a big bill passed over in the States and America are now taxing buybacks.
Yeah, so 1% tax on buybacks. And for people unfamiliar with the term, there are two ways that a company can return money to shareholders. The first is by paying a dividend. The second is by buying back stock. So remaining shareholders own a greater percentage of the company.
Do I care?
Do you care?
No. It's over in America.
Well, you own a lot of American companies.
That's true. No, that's not true. That is true. But here are two stats, Ren, to kind of contextualize this. The S&P 500 spent $280 billion on buybacks in the last 3 months alone, and a staggering $1.24 trillion on buybacks in the past 5 years. It's been massive over in the States. Companies have been going crazy on the buyback front.
Yeah, and there are two reasons for that. The first is the textbook reason. It's a more tax efficient way of returning money to shareholders. If outside of Australia, New Zealand and Malta, who have dividend imputation or franking credits, outside of those three countries, if you get paid a dividend as an investor, you get taxed on that, and the company's already been taxed on their profit. So there's a double taxation problem. In Australia, we get franking credits, so suck it the rest of the world. So the textbooks will say it's more efficient for companies to not to just buy back their stock instead. There is a cynical reason, which is a lot of company CEOs are incentivized to push up the share price, and a way to do that is to improve the per share metrics, and a way to do that is to have less shares on issue, so that will push up like your earnings per share and stuff like that. So there is a financial engineering cynical argument about the numbers that you just rattled off there, and there's also a economic textbook way. I think both probably are true in their own rights. But yeah, now there'll be a 1% tax as part of this big omnibus bill that the Senate just passed, probably going to pass the House this week. But I don't think it's really going to change anything.
No, it might change some behavior of companies. Maybe they'll pay a little more in dividends. Maybe they'll reinvest some of their profits back into the company. But 1% tax, not a whole lot.
I heard this CNBC anchor just losing it about it. Like, who are the government to stick their nose into a company's balance sheet and tell them how to spend their money? It's like, dude,
That's tax.
have you heard of tax?
Yeah.
Like,
What if they're doing it?
Sales tax, company tax, income tax. Like, companies government sticking their nose in all the time. Like,
Their job.
well, yeah.
Depending on which way you look at the role of government.
But yeah, it's just I think it's a pretty harmless tax. I don't think it will really change company behavior.
Yeah.
I think it's still more tax efficient than making an investor pay between 10 and 37% I think that's the range of income tax brackets over in the US. So, yeah.
It is what it is. So, Ren, single stock ETFs. Now, we've seen the transition over the last decade or so. ETFs originally set up by Mr. Bogle, Vanguard, to just track an index. Index tracking, that's all they were. Then we started seeing more, I guess, factor-driven thematic ETFs come through. And we've seen here in Australia, particularly, more and more ETFs come into the market that are more and more niche and providing different investment options. Now it continues. Have we gone too far with single stock ETFs?
Single stock ETFs. What the hell?
Single stock ETFs. Yes, that is what they are. They're an ETF that comprises one stock. There are three issuers. AXS Holdings is one. Dirixion and Granite Shares all have single stock ETFs.
Yeah, so looking into this, those are the three that have launched single stock ETFs in the US. Europe was actually ahead of the US here. They first launched single stock ETFs in 2018. But
Wow.
you hear that and you're like, what is the reason for this? And there is an argument. I don't know how good an argument it is, but some of the first offerings leveraged Tesla, leveraged Apple, leveraged Coinbase. So you buy the ETF and it's like 1.5 times Tesla. So for every 1% that Tesla rises, your ETF rises 1.5%. Then there's also inverse Tesla, inverse Coinbase, and one that I don't think will be too popular, inverse Apple.
Shorting Apple.
But I guess like that's the rationale, the use case, that you can have a product that's internally leveraged, or you can have a product that is short.
It's not bad, but it's just like you could, yeah. I see it. Obviously.
I mean, I see it. Yeah, it's happening. And there's been some big inflows. So have a guess what the most popular single stock ETF to date has been in the US.
Leverage Tesla.
Leverage Tesla.
Yeah.
Yeah. Oh, actually, hold on. Inverse Tesla.
Oh, inverse Tesla.
Yeah.
Short Tesla.
$50 million in inverse Tesla. Average daily amount traded, $50 million.
Okay. Pretty decent.
Yeah.
Not massive, but...
So here's my question, Bryce. Mm-hmm. Are they going to run out of stock tickers? Because...
you just put an L in front of the ticker of the company. Leveraged or inverse.
There's a world where it's like So right now they've also got NVIDIA, PayPal, Nike, Pfizer. And I guess like the question is, what's stopping them having every stock?
Nothing. You can definitely see that happening.
As long as you can find a way to scale your operations as an ETF issuer. But I imagine like if these get popular, there will be
100%.
platforms that help them do that.
Particularly on the short side.
So you'd have the actual stock, then you'd have an inverse, and you'd have a 1.5 times leverage, but then a 2 times leverage, 3 times leverage. So every increment of leverage up, and then you'd start having inverse ones that are leveraged as well.
Yeah.
So for one stock, you might have X amount of single stock ETFs, but then you're going to have competing issuers as well.
Yeah, but I mean, you have competing issuers with everything in ETF world. So
I'm just saying they're going to run out of stock tickets. The really annoying thing that I think will really frustrate me is it's going to get more confusing for the retail investor. So there's Tesla, TSLA. Mm-hmm. And then there's Tesla Bull 1.5 times, TSLL. And then there's Tesla Bear 1 times, TSLS. And then there's another issuer with an inverse one, TSLQ. And you can just see that people are going to get lost here. People are going to get confused.
They'll be buying things that they shouldn't be buying.
Yeah, they'll be
are unaware.
They'll just be trying to buy the stock, and it's so Apple, AAPL, and then there's a Bull 1.5 times AAPU, there's a Bear AAPD, there's a 1.75 times long AAPB. It's just going to get messy is my point.
Yeah, the Apple Single Stock Leveraged ETF, AAPU. Yeah, it is going to get messy. Again, though, this is why you got to look under the hood before you buy anything. Can't remind you enough of that.
What about this? We start fund of funds, ETF of ETFs, and we do an ETF of single stock ETFs.
Just leveraged ETF.
Yeah.
Just leveraged stocks. No. I could see myself getting around this in the short term, to be honest.
You are but a very short-term trader. And that leads to the two key watch-outs we want to point out here. So if this is something you are interested in, two really important things to keep in mind, as well as just the general, why don't you just buy the stock itself? So first of all, watch the fees, because it might be a single stock ETF, but there are still management fees attached to it. Granite shares, they're about a 1.15% management fee. I think that's their average across their ETFs. Directions are a 0.95% management fee.
Pretty expensive.
Yeah, pretty expensive for, especially like if you're getting a 1.25 times leveraged ETF. So it's not like massively leveraged, and then you're paying 1% management fee a year for the privilege. It doesn't.
No.
Anyway, so that's one. Watch the fees, because there are fees. That's actually going to be a problem with our ETF of ETFs.
Massive fees.
Yeah.
And we hate fees.
The second one, beta slippage.
Yeah.
Now, people might not be familiar with that term, but that's a key watch out with leveraged ETFs, and especially leveraged ETFs that track daily performance. Because over the long term, tracking the day-to-day performance might mean it actually slips from the long-term performance.
Yeah. Particularly with how most of these are set up with their synthetic derivatives and those sorts of things.
Yeah.
Not actually. The long positions could be better than the shorts. But it's hard. It just depends on how they're set up. Particularly in the States, you should be very careful with any leveraged ETF.
Yeah.
Whether they're actually owning the underlying stocks and leveraging internally, or if they're just buying derivatives based on it. Because slippage, essentially what Ren's getting to is that if it says you're going to get 5%, 1.5 times the price movement, that's based on daily performance, not over a long period of time. And so moves day in, day out, if it sort of slips each day over sort of a year or two, you might find that you're actually not quite near the total return if you were to times it by 1.5 or thereabouts.
Yeah, and I guess like the really simple reason is if a stock falls 10% and then rises 10%, it's not back to even.
No way. It's 50% up. Down. 50% down.
No, wait, what did you say?
If it goes down 10 and then rises 10 again, it's
not 50%
it's not
down.
50%, no.
Keep that in.
Don't say that.
Yeah. Anyway, let's not get bogged down here, but beta slippage, volatility decay, the problems with leveraged ETFs. If you are going to get into this world, it's important to understand that concept. So, Dior,
that's it. Now to close out, Ren, we can't miss what's been happening in the world of meme stocks. They are, I don't know if they went anywhere, but Wall Street bets are
they
getting...
definitely went somewhere.
Well, they're still the same stocks are still hanging around.
Yeah, but like they definitely
had a hiatus. Bed Bath and Beyond though is up 85% in the last 2 days at the time of recording. Wall Street bets absolutely getting around it. Bed Bath and Beyond, for those that are unaware, homewares retailer selling all things bed, bath and beyond. But
if you go to Wall Street Bets, the amount of people making just the amount of posts about Bed Bath and Beyond is pretty crazy.
Check it out on Reddit. But here in Australia, Ren, we also have a meme stock, IVZ, otherwise known as an Invictus Energy.
Yes. So if Wall Street Bets creates meme stocks over in the US, over here in Australia, we have ASX Bets. And I feel like this is a segment where we need Specky McGee.
Yes,
but unfortunately, Specky McGee is catching some sun over in Europe, so we don't have him here. But I was on ASX Bets, and Invictus Energy would have been going off the charts on the rocket emoji indicator. Have you heard of it?
I haven't heard of it, no.
Okay.
It looks like it's in a part of the market that I just don't pay attention to.
Yeah.
Small time. resources exploration.
Well, in March 2020, it was trading at 1 cent a share. It's now trading at 23 cents a share. It opened the year about 12 or 13 cents. So it's run up a bit, but it is an oil and gas company with a license to explore the Cabora Bassa Basin in northern Zimbabwe. According to the company, quote, one of the largest underexplored interior rift basins in Africa. So I am instantly out of my circle of competence.
Is this a meme stock or is this just a stock that's getting a lot of attention because of what it's doing? You know what I mean?
That is a great question, but like, what's the difference?
Well, I guess the difference is that the price run here might it's not like a piss take from an
it's
online
purely
community.
speculative. It's purely speculative.
Yeah, but there's a difference between that and like the AMCs and the Bed Bath and Beyond, where it's just like a let's get around it piss take vibe. You know what I mean?
Well, no, but like the GameStop wasn't a piss take. There was a legitimate.
But it is now. Like it's well and truly beyond any sort of company update that it came from.
True.
It's like well and truly now, literally just let's just run this thing as when we feel like it vibe. Piss take. Do you know what I mean?
I know what you mean.
Like I think any company that just runs on speculation isn't a meme stock. I think.
Yeah, well, I mean, yeah, most like mining explorers just have an element of speculation because there's so much uncertainty. I know what you're saying.
But I think the REI on this, the rocket emoji indicator, is the right call.
It's getting
It's
a lot.
on its way.
Getting a lot of buzz on Reddit. For me, that's a meme stock these days.
Right. Anyway, we're going to keep an eye on the meme market. Hopefully we can get Specky McGee on at some point when he returns from getting some sun over in Europe so he can talk us through what's been happening on the rocket emoji indicator. But Ren, that gets us to the end of today's show. There's plenty happening in markets. We'll be back next week with another market wrap to kick things off as more companies continue to report here in Australia and over in the US. Stay tuned. We've got plenty of experts as well. This Thursday, we're speaking with Nikki Shkevak from Blackbird, one of Australia's leading venture capital firms here in Australia, to get his thoughts on all things VC and what was it? Wild Hearts, Wild Dreams, and his process on investing in early stage startups. It's fascinating convo.
Yeah, early investor in Canva, early investor in Zoox, the self-driving car startup that Amazon bought. So some great stories there.
And we're joined by Natalie Brunel on Friday from the States, who is potentially one of the most bullish people I've ever met on Bitcoin. So I just want to put that out there. She's incredibly bullish. You'll understand why when you listen to the episode, and we will caution it that it is not representative of our views here at Equity Mates.
We might have to top the actual episode saying this as well.
Yes,
but if you love crypto, you'll love her. If you hate crypto, you'll hate her. Either way, just give it a listen.
Just give it a crack. That's on Friday, and we'll be back next week to chat all things stocks, Ren.
Sounds good.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.